Hey investors, welcome back to the Real Estate Hackers channel. I'm Dave Hathaway, and today we're going to analyze the York, Pennsylvania real estate market. First, we're going to look at the overall market, and then we're going to take a deep dive analyzing an actively listed rental property to look at potential returns and see how much investors like you and me can make. By the end of the video, you're going to know fundamentals of the York market, population growth, unemployment, median sales price. You know how much money rental properties in York make today, and you're going to know whether buying investment properties is a good or bad decision, in my humble opinion, with looking at cash flow and appreciation. So we're going to look at the address 2134 Maplecrest Boulevard, 2134 York, PA 17406. But before we analyze that specific property, let's take a quick look at the overall York market. So it has a population of 44,919, growing at 0.06%. And it's been growing a little bit since 2000. So that's a really good sign. It's a very similar population to Harrisburg. Basically, it's next door neighbor in Pennsylvania. It has an unemployment rate of 3%, which is lower than the national average. Average salaries there in York, according to ZipRecruiter, are $50,704 a year. That's average. Median sales price in York is $221,833, and it's up year over year. And looking at this data, I do notice that the median list price is 10% higher than what the sales price is. To me, that says the market could be softening a bit, or as an investor, you have better leverage to put a lower offer in on a property, and it will probably get accepted. So median rent in York is $1,225, up $30 year over year. So that's good that it's steadily going up. And the price to rent ratio is 15.09. And price to rent ratio, if it's 15 or below, that means that you can find cash flow in the market. So we should be able to find some cash flow, as we are right at 15. York does not have any Fortune 500 companies. However, it does have some large employers, including York Hospital, Amazon, BAE, and Harley Davidson. So it's kind of got a diverse group of employers. It doesn't have any major sports teams. It doesn't have an international airport. However, it is 30 minutes from Harrisburg International. And so technically we can count that as an international airport that people can get to. Cool things about York is it does have one of the largest Harley Davidson's manufacturing plants where you can tour and see how the bikes are built. That's pretty cool. Overall market verdict, I'll give York 1 thumbs up. I won't give it 2 thumbs up because it's missing a few items here, but I'll give it 1 thumbs up as a growing market, a stabilized market that you probably can find some cash flow in. So moving along to the Google Street test and looking at this property, and I chose this property for a certain reason. This is a newer built condo. It's a townhouse condo built in 2005. But one thing that I want you to realize, and what I've realized as an investor, is often in these older markets, they have properties that are built back in the 1900s, so over 100 years old. And as an investor, I've realized if I purchase those, which I've purchased some over 100-year-old properties, if they have been fully gutted down to the studs in the last 30 years, they are more likely to have higher maintenance costs, more maintenance calls. So they're just a little bit more, we'll say more work, more stress compared to a newer build property. And as I progressed in my investing journey, if I can purchase a property that's a newer built, even if it's more expensive, I will go for that newer built property because it's going to have CPVC. It's going to have things that are a little bit nicer. I'm not going to have to worry as much of liabilities like electrical systems in the property, like lead-based paint in the property. And so this is just another thing I think about when I think about property. So I wanted to see if this one would cash flow on our analyzer. So I'm going to give it a pass for the Google Street Test because a newly built community, it looks beautiful. It's got sidewalks on both sides and there's no trash, there's no nothing in this community. So it gets a pass for the Google Street Test. Moving along to the listing details, this property is listed at $224,900. It's a 3-bedroom, 3-bathroom townhouse condo. It has 1,752 square feet, so it's a pretty big townhouse. It's built in 2005, and the interior of the property looks pretty good. There's not a lot to renovate in this property. When I'm looking at this townhouse, there's not a lot that I would do. But even with a newer property, you should always put some sort of contingent in there that you might have to spend. So I'd put like a $5,000 contingency on this property. It does look like it has LVP flooring. It does have laminate countertops in the kitchen that I don't love, but they're in good condition. So I'd keep them, let the tenants beat them up for a couple years. And then once they're old or once they're starting to look ragged, then I'd put granite countertops. But I don't think you need to do that now. And so I would put that $5K renovation budget in there, even though I don't think you'll be using it. With that, I'd like to plug our renovation course. If you're struggling with renovating properties or finding great contractors, we got a course, link in the description. It's called Master the Rehab 101. If you use the code RealEstateHackers10, you'll get 10% off. Moving along to the analyzer of this property. This property should rent out for about $2,100. I see another property in the neighborhood. It's slightly bigger, renting out for that price. And so I feel comfortable putting $2,100 in the analyzer. Property taxes of this property about $3,699, so pretty high. And the other thing you want to note in this analyzer is you have to put in that HOA or condo fee, and it's $185 a month, which is expensive, and that's going to kind of kill our cash flow, as you'll notice in the analyzer. Our cash flow on this is $1,147.75 or 5.71% ROI. This is a cash on cash return, meaning that you get this return if you purchase this property and renovated it with 100% cash, no financing. If we finance this property with a DSCR loan, a 30-year fixed DSCR loan, if you don't know what that is, check out this video over here to see everything you need to know about DSCR loans. But if we purchase this property and it was at a 75% loan to value, our cash flow would be $35.82 or 0.71% ROI. And even though there's a little bit of cash flow at $35, that usually means you're going to have zero cash flow or negative cash flow when it's that low. So you are not purchasing this property for cash flow. You'd be purchasing it for appreciation over time. There's a few different strategies that maybe you can make this one work. I don't like to recommend properties that have zero cash flow to investors. I wouldn't purchase one myself, but if I was looking to live here in York, this could be a good property, and maybe I could figure out a way to rent out the other rooms where I live in one room, rent out a bunch of the other rooms, and maybe that helps you get a neutral cash flow while living in the house for free. That could be a way that you invest in this property and make it a good deal. Otherwise, you have to get a lower sales price. And so if you got this one for maybe $175,000, $40,000 or $50,000 off, this one cash flows about $300 a month. And that could work. So just getting a better sales price could work. But just know that you're getting this one for appreciation and not equity. So other than that, thanks for watching the video and subscribing to the channel. I'll see you guys in the Real Estate Hackers community.